My name is I'm Deputy Head of Turkey, in charge of the financial institutions in European Bank for Reconstruction and Development. I have a pleasure to moderate our second model of the day, and I'm surrounded by the three worldwide experts on the regulation and supervision. The objective of our panel today is to understand the impact that the technology has on the financial regulation and supervision, also called Suptech and Regtech. And I'll go into introduce the first speaker for the day, Mr. Joseph Nas, who is the member of the Secretariat of the Financial Stability Board, and before then he's been working with the Bank of England. So, Joseph, can you tell us what the Suptech and Regtech mean?
Sure, thank you for that introduction, Oksana. So, in terms of what they mean, I can speak to the definition that the FSB settled on in the work that was undertaken by its membership earlier this year. Suptech we define to be the use of technology to support supervision and oversight. One of our members actually suggested there should be a third acronym of tech, oversight technology as well, but too many acronyms, particularly acronyms that involve lots of consonants, didn't end up making the cut for publication. So Suptech and Regtech is what we ended up going for. So Suptech is the use of technology to support supervision. It typically involves the digitization of reporting, improving the efficiency of regulatory processes. Regtech is the application of technology by the private sector to their regulatory and compliance requirements. One sort of problem that we encountered with these definitions is that the use of technology, both by financial firms and by regulators, is nothing new. These sorts of trends have been going on for, well, quite literally decades. The reason why there's been this sudden absorption of these applications of technology into fintech is the recent sort of acceleration of developments that we've seen over the last few years. Advances, that's come about due to advances in computing power, and in particular machine learning techniques, new kind of semantic standards like the legal entity identifier framework that allow different sorts of data and technologies to effectively speak to each other, some of which have been spurred by regulatory developments, including some of them from the FSB on OTC derivatives, and also some of the demands of industry as well. So new regulations, MiFID, Solvency II, etc., have given rise to enormously granular data on exposures and on transactions. There's a sort of duty, if you like, on the part of regulators to make sure they're using that data efficiently and effectively, and also competition, particularly in some jurisdictions, between financial firms and within banking sectors. That's driven this desire, I think, to improve the efficiency of reporting functions, particularly reporting functions that have traditionally been very human capital intensive. So these aren't new developments, but they're new definitions that have, I think, been spurred by the recent acceleration of developments in this area of fintech.
Thank you very much, Joseph. Thanks for commenting on the Financial Stability Board's latest development on this. Let me turn to the second speaker of the panel, is Mr. Günter is the Senior Manager in the Statistics Department of the Austrian Central Bank, OESB. And for the last 6 years, Günter has been working on the development of the integrated reporting data model for the financial sector in Austria, and coordination of this effort with the financial participants. So can you tell us more about this? Is this the sign of the Suptech industry?
Thank you very much for the nice introduction. I don't know, we had a lot about Regtech and FinTech. We had a kind of a definition now from Joseph, from Regtech and FinTech, and from the speech of the governor, he had also a kind of a definition of FinTech and Regtech and Suptech. And let me go back to the point in time when I started to work at the Austrian Central Bank. It was in 2001. We already started at this time to collect data on a security by security basis. So we collect securities on a security by security basis and tried to make the collection more efficient. And we tried to avoid and to reduce redundancy. So it was already at this time a kind of a first signal of Suptech, because as we heard from your governor, from the governor of the Turkish Central Bank, and from Joseph, Regtech and Suptech is to support banks and to support the regulators to make, among others, to make reporting more efficient. And that's what we already tried to do in the Austrian Central Bank already at the beginning of this century. In the meanwhile, more or less all Euro area countries collect security by security data for statistical purposes. Why does this kind of a collection support banks and make data collection more efficient? Because it's on a granular basis, it's more or less a standardized form of collecting data, and you can use as a central bank this data for multi-purposes. So the data are not collected multiple times, but they're collected only once and then used in the central bank for different purposes. And then, after the financial crisis, the reporting requirements were exploding. The costs were exploding in reporting. I don't know if the audience and if you are aware of all the reporting requirements in the euro area. The banks in the euro area have to report to the central banks and competent authorities a lot of data for monetary statistics, interest rate statistics, external statistics, payment statistics, and here I'm only talking about statistics. And then, of course, for supervision, they have to report data for credit risk assessment, for operational risk, for market risk, and FinRep, meaning balance sheet data. So they have to report huge amount of data. And nowadays they have in the euro area also report data on a granular basis, on a loan-by-loan basis, starting on 25,000 euros, it's called in the euro area under credit. So you see, they have to report, and here I'm talking only about stock data. I do not talk about transactional data. I have not mentioned EMIR data, transactional data collection for derivatives. I have not mentioned data collection forms for money market transactions. So I just talk about regular transmissions and reports to the central bank and competent authority on a granular basis, on a regular basis on stock data. So you see there is a lot of data to be reported from the commercial banks to the central banks and competent authorities. I remember in 2010, a manager of one of the biggest banks in Austria came to the Austrian Central Bank, and he just proposed, please connect your reporting system to our reporting system, and I send you all the raw data we have and do what you want with this data. Sounds very easy. Of course, it's not easy and it's unrealistic, because at this time there was no harmonized, standardized interface from the central bank to the banks. Every bank has a different system. Within a bank, there are different systems. Between the banks, the systems are different. Definition of fields and attributes are different. The names of the attributes are different. So it was impossible just to connect our system to the system of the bank and just take the data that we want. Another question was which data, at which granularity, what means raw data. A third question was about legal background. Is it allowed to take all this data, for instance, from households to the central bank and do the aggregations? No, it was not possible, but it was a clear signal that the situation was unsatisfying for reporting already at this time in 2010. So what we decided at this time is to cooperate with banks and just to find new ways, more efficient ways in reporting. So we decided in about 2012 to go for a new way of reporting. And the three main pillars of this new approach in reporting are a strong, really important cooperation between the central bank and the commercial banks. We have a so-called standing committee on reporting, a central committee where all the reporting items, issues are discussed with banks. We meet on a mid-management level, I guess 6 times a year, and on an expert level about 20 times a year. So it's really a very intensive cooperation with banks. The second pillar and I will come back later on that, is the foundation of the so-called Austrian Reporting Services GmbH, a subsidiary of the biggest banks in Austria. It's a kind of a service, reporting service platform, just founded for reporting purposes. And the third pillar is this integrated reporting data model. This reporting integrated model, the main element is the so-called basic cube. What is the basic cube? The basic cube is a standardized, harmonized interface from the bank source systems to this logical data warehouse, to this logical database, and from this database to the central bank and the competent authorities. The basic cube describes all business cases of banks needed for creating, generating reports to the central bank in a very granular way, in a case-by-case basis, sometimes in a exposure-by-exposure basis. It means you find in this database, in this logical database, you find a precise description of all business cases, deposits, securities, financial derivatives, loans that you need for reporting purposes. All the attributes, all the values, the relationship to collaterals, for instance, the relationship to entities, borrowers, creditors, protectors, everything is here described in a very precise form and in a formalized form. So all these attributes and the algorithms to enrich this basic cube are described in a formal language. And additionally, there is a kind of transformation. There are transformation rules from this basic cube, from this granular logical data model to all the reporting requirements, to templates from the EBA to all the other reports required by the Austrian Central Bank. And all these transformation rules are described in a formalized, in a standardized way, so that a bank can take this logical data model and implement it at home, more or less in a very automatic way. This is the main element of our integrated data model. And additionally, you have these transformation rules and then the final reports. And in the case of statistics, we changed our reports completely. Traditionally, each division, each party wants to collect the data as they want the data. So in an aggregated form, one-to-one, and in principle, then there are a lot of redundancies. So a loan is collected often 10 times, but not as a loan, as a single loan, but in different aggregates with different breakdowns. If you think about this unaggregated I mentioned before, this loan-by-loan collection, if you collect it as a loan, one-to-one, and additionally 10 aggregates of this loan, then you have a lot of redundancy and a lot of risk of consistencies. So what we did in Austria with our system is just to minimize and reduce the redundancies and try to collect it only once. Try to collect the data in the statistical area, not in the supervision area, because there is, from a legal point of view, not allowed to collect the data as free of redundancy as possible. So the data model, and this is one of the main messages, is the data model try to reduce or try to increase consistency or try to reduce inconsistency of all the data. In principle, or often you have inconsistency between banks, often you have inconsistency between reports of the same bank, and you have a lot of inconsistency between internal reporting of a bank to their management and the reporting to the central bank. And then you have inconsistency often between granular data and aggregated data. With this data model, we try to avoid and try to reduce this inconsistency and try to incorporate more consistency. Please let me also say some words to this RREP, because I just talked about a logical data model. It's a long way from the logical data model to implementation of this logical data model. What we did in Austria is that the biggest banks in Austria founded a subsidiary, an own subsidiary, just for reporting purposes. This RREP covers 90% 90% of the Austrian market in terms of balance sheet totals and in terms of number of banks. So this OREP is responsible for reporting for 90% of our banks, and this OREP implemented our logical data model more or less one-to-one. So there is a guarantee that we have a harmonized data model and a harmonized implementation of our data model. And this ensures quality and consistency, as I mentioned before. So the OREP is a big step and a very important pillar of our reporting process. Let me say some words. How is it now about the process now? You can ask, is it possible now that the central bank has access to this data warehouse, which is implemented by OREP and which also runs at OREP at one single corporation? No, we have no access rights, and it would be technically possible with APIs or with something else to get the data, and now it would be possible because we know the structure of the database, we know the logic of the database. So in principle, in theory, the Austrian Central Bank could connect now, it is possible, could connect to this data warehouse in OREP and get the data they need for compilation of reports. But it is not done, so we still don't have this kind of pull approach, we still have a push approach. It is not done because there are many questions to answer for this approach. Who is responsible for data aggregating? Is the bank is the central bank responsible for aggregating a FINREP or a financial statement? Is the bank responsible for aggregating risk figures? So then there are a lot of legal questions. So at the end, the market decided not, at the moment, it is not the interest of the central bank and of the banks that we have direct access to this harmonized, standardized interface and to receive all the data we need. So it's a harmonized model, but still the banks are responsible for creating, generating, producing the final reports and send it to the Austrian Central Bank. So it's in principle they feed the basic cube, then the basic cube is enriched, then the banks push the button to validate the final reports, and then the final reports are sent to the central bank. Let me spend the last words on Suptech and Regtech. As I mentioned before, we heard about definitions to Regtech and Suptech. And why is this integrated data model seen and called as a Regtech and Suptech application? I guess, and this is what we heard about from the governor of the Turkish Central Bank, it's about make data managing and data collecting more efficient for the market and try to reduce inconsistencies and redundancies and increase at the end data quality. And I guess that's what is our data model and what is our integrated reporting approach about. It's also more flexible, and at the end it should reduce costs.
Thank you very much, Günther. I'm sure that we'll have a lot of questions related to this integrated data model. And let me talk to our last speaker, the third speaker for the day, Mr. Untitled Chapter. Mr. Jadwalk has been a program leader in the Toronto Center, and before then he's been leading the advice to the financial regulators across the world during his World Bank advisory capacity in the areas of the macroprudential policies and the financial stability. We tend to, and following from the first panel, when we talk about fintech, everyone is and technologies, everyone talks about the risks and threats that it presents to the regulation and the supervision. So it would be interesting to hear your views on what the opportunities that technology presents for the regulator.
Thank you, Oksana. It's a pleasure to be here. I think to understand the opportunities, first we need to understand what exactly is the tech component in Suptech and Regtech. And supervisors already experiment with a multitude of new tech tools. I think these fall roughly under two major headings, big data techniques and machine learning. And I think it's worth looking at the salient features of these new technologies, also their limitations, in order to judge what sort of opportunities they offer for supervision and regulation. So, big data. I mean, we've seen huge advances in data storage capacity and computing power. So now we are able to retain and handle much more data. So the depth and breadth and the frequency of the data that we can potentially use in our analysis has increased tremendously. Plus, there are new analytical techniques to new approaches to find patterns, clusters, and visualize the information that is in the data. As a side remark, these new techniques are often called data mining, which was quite confusing for me when I first heard it some 10 years ago, because those of us who learned econometrics, we were taught that data mining has a negative connotation. It refers to a practice of twisting and turning data to squeeze out actually more information than it actually has. But this new use of the term is coming from a completely different subculture, the database communities, and they are very enthusiastic about it, and it refers to some kind of knowledge discovery, let the data speak without any priors, and so we have to keep that in mind. So in general, more data or richer data is always welcome by people who are doing empirical work, empirical analysis. But at the end of the day, what matters for our decision makers is whether this huge amount of new data improves the signal-to-noise ratio of the analysis that they receive. I mean, if it brings more noise, more false positives, false negatives, then it's probably not worth the huge effort that they invest in getting this data. And I think there are areas in supervision and regulation where big data is clearly presents an improvement, and other areas where the potential contribution is more doubtful. I'll present some examples later on. The other big innovation is machine learning. We've seen spectacular achievements recently. Everyone who uses Google Translate sees that it's getting better and better every year. And probably the last bastion of human superiority in strategic game playing was the game of Go, which was much more complex than chess, and it was too complex for computers worldwide to crack by sheer power. But I think last year, machine learning did the trick. The AI, which was built by DeepMind, a British company which is using this deep learning algorithms, has finally beaten the human grand champion of Go, and it beats it consistently right now. And I think it needed just 2 days of training itself. So what are the important features of machine learning? One is that it typically needs a set of training data that is inputs and conclusions on which the AI is trained. So for example, if the task is translation, then it needs a huge body of text. I think the term is corpus of text, which is already translated from one language into another, so that the AI can be trained. Or closer to our context of supervision, probably it needs a huge amount of supervisory assessments with all the information that the supervisor, the human supervisor, saw and assessed, complete with the diagnosis, whether or not he found something fishy. So that will be important for machine learning to be used in this area. Another feature of machine learning, especially the unsupervised learning and deep learning, is that we lose track of what is happening within the AI. We don't really know how it comes to the final conclusions. So it basically becomes a black box. Now, in certain applications, there's no problem with that. I mean, if you use machine learning algorithms to predict on the short run equity returns, and if it's doing its job, you're making money, you don't really care what's happening inside. But if you have to make a high-level policy decision, say you have to set a counter-cyclical buffer, then suddenly, I mean, it may have real economic consequences for the short term. So the accountability of decision makers suddenly comes into play. They may need to explain publicly why they made this decision, and it can't just say it's because the algorithm told it, right? I mean, maybe in 50 years' time when we are fully confident in AI, but definitely not now. Okay, so after looking at these basic features, I mean, let me give an example of what sort of opportunities these new technologies offer in one particular area of supervision, which is more my cup of tea, macroprudential supervision, just to illustrate the opportunities and challenges. Well, macroprudential analysis can essentially be broken down to two major areas. First is systemic risk monitoring. That is probably the more well-known part. That is what you see, the result of which what you see in the financial stability reports of central banks. But it also has another function, which is policy simulation, or supporting the policymakers when systemic risk monitoring suggests that something has to be done. They have to decide which policy tool to deploy, how to calibrate it, what would be the effect on systemic risk, what would be the transmission, and whether there are any short-term real economic trade-offs. Coming back to systemic risk monitoring, again, simplified to the extremes, it has to answer two questions. What's the probability of a systemic crisis taking place in the near future? That's a fundamental question, and that's what we use the early warning systems for. And early warning here means it has to be early enough so that you can take mitigating policy action, and this policy action has the time to play out its effect. So we're talking about at least half a year, 1 year ahead. The second area is, if a crisis, second question that systemic risk monitoring has to answer, if a crisis happens, how resilient is the financial system to survive? And currently, the basic tool that we are using for that is stress testing of say, the banking sector. Now, let me go through the opportunities the new technologies present in these areas of macroprudential analysis. Let me start with stress testing. I mean, this, as we know, always requires a tremendous effort of pulling together data, collecting data, structuring data, and anyone who worked in the Europe-wide stress test can, I think, testify that this is really a painstaking effort. So here, I think the big data solutions, the kind of reporting that Günther was talking about, or actually going a bit further, this kind of automated reporting where with a data pool approach where the supervisors can actually access at any point of time any data from the IT systems of the supervised institutions, it offers a big improvement. So I think the holy grail here is some sort of a simplified stress test that is automated and runs almost continuously and gives a reading of the resilience of the banking sector at any point in time. Regarding the early warning systems, frankly, I think this is an area where I have doubts about the merits and the potential contribution of either big data or machine learning. There is an empirical observation that financial cycles have a very long, low frequency. So crises, on average, occur 10 to 20 years. Of course, it depends on country. My Argentinian colleague from the World Bank would be laughing at me. But I think in Canada, you hardly ever had a systemic financial crisis in history. But on average, this is the frequency that we are talking about. So would having, and these cycles are driven by the build-up of imbalances which are really slow. The diversion of credit from its equilibrium path, a slow increase in the debt-to-service ratio, again, diversion of real estate prices from some sort of equilibrium. So long-term processes. So the question is having access to data with more frequency and about the minute details, would it add a lot to the prediction of this crisis? And that's where I have my doubts. I think that the sort of big data that we now have access to is which is typically available for us from payment systems, from the interbank market, is useful for forecasting a crisis on a very short horizon, or even nowcasting a crisis, but not on the typical policy horizon that we need these early warning systems for. The other shortcoming is that since these systemic crises are so infrequent, it means that there's by far not enough training data to train machine learning algorithms to predict them. So the corpus is really small. And finally, to the area of policy simulation. Once our systemic risk monitoring detects a problem and policymakers have to act, their first problem is the choice of policy tool. Macro-prudential policy is different from monetary policy. You have a multitude of tools. So which one to choose? There's a lot of ways to slice and dice these tools, but one fundamental division is between tools that operate on the supply side, on the bank side, such as capital surcharges, risk rates, and on the demand side, on the borrower's side, caps to payment to income ratios, debt service to income ratios, and so on. So the problem is it's very hard to tell if a credit boom is driven by supply or demand. On the other hand, if you choose your tool wrongly, you will end up with distortion. If the credit boom is predominantly demand-driven and you try to contract supply, you probably end up with an effect on the price of loans, on lending spreads, driving them up and actually inducing more adverse selection and then problems that will lead to worsening of the portfolio quality, so it defeats your purpose. So you have to choose very carefully. But it's hard to tell. Some inference, of course, can be made from the relative dynamics of lending volumes and prices, but it's not always conclusive. So central banks are typically relying on additional information, and I work in central banks when they use lending surveys or senior loan officer surveys for this purpose, in which they ask banks about whether they tightened or loosened non-price credit conditions, such as collateral standards, maturities, and so on, to help assessing whether it's a supply push or not. The problem with these that these are qualitative surveys. So they answer, yes, we tightened a little bit, tightened very much, loosened very much. towards tightening. Banks want to seem prudent, they want to please their supervisor, they don't really confess to substantial loosening. And sometimes they are not really taken seriously by the banks. I mean, when we introduced these in Hungary, after a couple of years, I asked one of my friends who was working in a bank, and we called it a senior loan officer survey. Who exactly fills these forms, these lending surveys, out in your bank? And the answer, that usually lands on the junior colleagues' desk. If it's the summer review, it's typically the summer intern who fills them out. So there is some information in them, but it's not really reliable. So if we have more access to more granular data from these big data pools on non-price credit conditions, or any machine learning algorithms that help us indicate changes in banks' risk appetite, eventually shifts in their supply, that would be a great help in this particular task of macroprudential analysis, of telling decision makers which policy tools to choose. So that's it. For me, I just wanted to illustrate that these new techniques offer opportunities in certain areas, but we have to be careful about, we have to manage our expectations, because in some areas maybe their use is not so promising.
Thank you very much, Attila, and thank you also for explaining and commenting where the your ex-employee Central Bank of Hungary stands. Maybe we can come back to that if you have more time. Let me turn back to Joseph and ask, we talk about the conservatism of the central bankers in the first panel, and I think it's your colleague from the Bank of England who was saying that it's just what we try to consolidate on what we know and sort of dismiss what we don't know. What would, in your opinion, change the mindset of the regulators to expand the use of technologies in supervision and regulation?
Would change their mindset? Well, I'm tempted to say, perhaps slightly provocatively, another crisis. Who knows? So if there were another crisis that brought about some of the risks that Attila and other speakers have alluded to, that might change regulators' mindsets. And it could change policymakers' mindsets in two different ways. So I suppose if we ended up in a few years' time missing a load of risks, despite having access to all this wonderfully new, innovative data and the ability to process it, then we might see a sort of dampening of some of the fervour around some of these innovations. And some people might say that's a shame. On the other hand, we might see increased interest in some of these innovations, particularly innovations that enabled the real-time monitoring of financial institutions' exposures and the real-time monitoring of financial markets. A second thing, maybe a less sort of apocryphal thought on what might prompt a shift in mindsets, might be a change in the structure of the financial system. So in a lot of our members' jurisdictions, you still have a situation where elements of the financial system, particularly the banking system, are still reasonably concentrated. That might change over the coming decades, including due to all the sorts of innovations that we see in fintech space. Now, if you had a situation develop where suddenly central banks and regulators had to monitor and be in touch with an order of magnitude greater number of institutions, then that might increase the onus on all the sorts of information, automation technologies that we see in Regtech and Suptech space. So that's a couple of things.
Thank you very much. And Joseph, I know that you have an interest in the impact that the recent market-based financing expansion had on the policy tool. Would you like to comment on that?
Well, the expansion in market-based finance we heard from John earlier raises this issue about the number of institutions that interact or should in future be allowed to interact with the central bank. So you see, for example, in the United Kingdom, there have been moves over the last 5 years to suddenly broaden the number of institutions that have access to the central bank's balance sheet. And that's due in part to the growth in market-based finance and also the growth in central clearing requirements as well. And that, in that jurisdiction, has been one of the driving forces to spur the adoption of some of these new technologies, some of the reforms to the payment system that John mentioned. So I think the growth in market-based finance is part of that.
Thank you very much. Let me turn to Günther now and ask about the other, whether you're aware of any other European initiative to develop the sort of integrated data reporting model.
Thank you. There are a lot of European initiatives that are very similar to the Austrian initiative. For instance, there is the BIRD, the Banks Integrated Reporting Dictionary. It's an initiative of the European system of central banks together with commercial banks. So it's also a strong cooperation between commercial banks and the central banks to develop a similar logical data model as I described the Austrian Basic Cube. So this Banks Integrated Reporting Dictionary should describe banks' data on a very granular level very precisely to allow banks to fulfill and to meet the reporting requirements. But it's not only a description of all the data you need to fulfill these reporting requirements, also the transformation rules from this granular database, very similar to the Austrian model, is described in a very formalized, standardized way. It's called the validation transformation language, which is used, which makes it possible for banks and for software provider to implement this data model in a very automatic way. So it's a very big step, but I would still say it's at the moment on a dictionary basis, but I hope that it will be a success within the next year. So it's more or less shifting this Austrian model into a European or Euro area model. And then you have a second initiative of the ESCB, it's called Integrated Reporting Framework. This BIRD is a kind of the input layer. How have the banks to arrange their data to fulfill, to meet the reporting requirements? On the one hand, on the other hand, how do the central banks and the competent authorities arrange the reporting requirements to make them as redundancy-free and as consistent as possible. So it's more or less a way away far from traditional templates to more multidimensional reporting forms, which fosters and forces the principle of collecting the data only once. It's also very, very similar to the Austrian model at the moment, just for statistical purposes. And we have a third initiative in the European Union. The EBA, the European Banking Authority, will be mandated within the next month, I would say, by the European Commission to make a feasibility study about an integrated reporting system for prudential, resolution and statistical purposes. So this is the next step to integrate all fields of data reporting. So I will be very, very interested to see what will be the results of all these three initiatives I mentioned. All the three initiatives have the same aim of harmonizing definitions, reducing inconsistencies, reducing costs, and reducing redundancies. It was very interesting for me to listen to Attila, because he told us a lot about the tools, how to analyze with new technologies, how to analyze all this data. And he also mentioned this pull approach, which was also mentioned by my before from myself. If you have access to this granular data, and if you try to get this data, or if you have this pull approach, the key element is the data quality of this granular data. When we talk about using new technologies for exploring this data, for analyzing this data, when we talk about the pull approach, the precondition, and it's really, I guess, the most important thing here, is the data quality of this data. And the data quality management in the banks is different and is often on different levels. So in many cases, banks run parallel systems. They run a system for external reporting to central banks and to competent authorities, and different other systems for internal reporting to the management, for production of a financial statement, for risk management. Often they have different systems and different correction procedures. And in many cases, the correction of the mistakes are done at the aggregated level in different systems. So if we want to pull and if we want to get the data, the granular data with a pull approach on the basis of a standardized interface. So the first thing is that you have a standardized, harmonized interface. The second thing is that you have the quality in this basic cube. Otherwise, you receive the data, the granular data, which are inconsistent, where the quality is poor because the correction of the mistakes are done at the aggregated level. This is traditionally the case in many countries, I would say. I have a lot of experience, at least in Austria, I can say that was in the past my experience and the past practice to correct the final reports, to make them more or less smooth, to get as less and as few reactions and requests from the central bank as possible. And so it must be the aim to use this data and use these modern tools and these new technologies to explore this granular data, to look and to ensure and guarantee the quality of the basic cube. And the next step would be, from my point of view, and this is my personal point of view to be honest, the next step would be not to run parallel system, to use this logical data model with some extensions also for internal purposes, so that the internal management, the internal reporting to the management and for different purposes, and the external reporting to the central banks are consistent. This is the next step. And the third step, if this logical data warehouse has a good quality and has proven that it has a good quality, then we as a central bank, and yes, as I mentioned before, to be honest, this is my personal view. I don't know what my governor would say to this view. I would say the next step could be, or we should, as a central banks, could ask us, is it really necessary to collect all this data, which I mentioned before, on a regular basis, on a monthly basis, on a quarterly basis, on an annual basis? Or would it be with such a logical data model and with the pull approach to access granular data, would it be sufficient to collect on a regular basis, monthly basis, quarterly basis, only, let's say, 30%, 40% of the data, and then do ad hoc requests, analysis, as it was mentioned by Attila, when you need the data. And this, we call this kind of approach a passive data approach, but as I mentioned before, a lot of preconditions have to be fulfilled before to come to this world of new data reporting, and let's see what the world and what the next year are bringing.
Thank you very much, Günther. And you've alluded the way you've addressed the creation of this integrated database by creating a subsidiary of the central bank in Austria. Who will the cost of that? It's an upfront cost.
This is a full subsidiary of the commercial bank, so Austria has no, the Austrian Central Bank has no participation in the bank, so the costs are divided by the owner of this reporting company. But at the end, of course, there were a lot of initial costs, but at the end there is the aim, of course, to reduce cost of reporting because of the synergy effects of these Austrian reporting services.
The question that I have to our last speaker is, you've already alluded about the financial crisis management and the advantages and disadvantages of the using technology in that. Can you expand on that?
Sure. I think there's clearly a role for these new technologies in crisis management, even at a very early stage of handling a crisis. And let me give a concrete example. Because the first problem in crisis management is often to tell whether we are in a systemic crisis or not. Of course, Ex post, it's trivial to say. It's relatively obvious that, say, in October 2008, and many advanced countries were already in a systemic crisis. But yeah, in real time, at a very early stage, it's very difficult to tell. There are very conflicting information coming in from different market segments, so it's really a hard decision. On the other hand, a quick assessment would be essential because acting late in crisis management has huge costs. And in addition, in some jurisdictions, there is a legal requirement for a formal declaration of the systemic crisis by the central bank or by a national financial stability committee in order to be able to access certain emergency measures or public backstop or say public guarantee for emergency liquidity assistance and things like that. So it's really an essential question to make that assessment. So the decision makers need some conclusive guidance on how to assess data coming in from different market segments. And for this purpose, many central banks have developed contemporaneous indicators of systemic stress. These indicators are not intended to be forward-looking, as opposed to the early warning indicators. They are intended to measure the stress in the system as it is now, right now, and help decision makers whether the stress has reached systemic proportions already. I think the European Central Bank's composite indicator of systemic stress, or the KISS index, is a very good example, but similar indices have been designed and implemented in many other countries, including emerging countries as well. So these indices typically use high-frequency financial market data coming from different market segments, the forex market, the government securities market, the equity market, the interbank market, and also importantly from the banking sector. Now, the banking sector data is a bit of an odd one out because the primary data that supervisors can turn to, the supervisory returns, are coming in with a much lower frequency. They are usually quarterly or monthly reports. So they are not much used in a high-frequency index. We're talking about the daily index here. So the way to come around this problem was to use secondary data, the market's judgment about the banking sector, such as credit default swap spreads or bond yield spreads on bonds that are issued by the banks, or the equity prices of banks. So this is actually looking at the banking sector's health through the mirror held by the financial markets. It's based essentially on public information, which is not bad, but maybe not ideal, because the supervisors in principle have access to private information about the bank's health. It's just not with the right frequency for this purpose. So again, I understand fully the practical details, but in principle, if this ideal data pool reporting technology becomes widespread, then the supervisors can subtract high-frequency data about the liquidity and solvency situation of banks, which could be a very useful component to these stress indices. And as I understand, some central banks already use machine learning algorithms to identify liquidity stress from payment system data, RTGS data. I think these kind of results can also be incorporated in these stress indices and help decision makers assess whether we are in a crisis or not. So in general, my feeling is that it is actually this kind of short-term prediction or nowcasting in which big data analysts and machine learning has a kind of comparative advantage vis-a-vis traditional econometric techniques which rely on more structure and more economic theory and probably are more suitable for long-term forecasting operation.
Thank you very much, Attila. And Joseph wanted to comment on that.
I was just going to add the cautionary note that some of our membership injected when we worked at the FSB, when we thought at the FSB on the potential for some of these techniques to be used, either in crisis management or crisis spotting. And I guess that cautionary note is just to remember that a lot of these big data techniques, machine learning techniques, artificial intelligence, are essentially looking for fancy forms of correlation in past data. There's nothing wrong with that, but it's important to remember, perhaps, that financial crises do have certain similarities, but they also have differences. And some of the correlations that might emerge in regulatory data, or some of the correlations that might emerge as some of the data that firms are using themselves for commercial purposes, might not be entirely robust in a downturn. I mean, just to give you a couple of examples, I was at a fascinating seminar with a few big tech firms at the London School of Economics back in the summer. And one big tech firm that's very active in retail and very active in payments space, said they'd spotted in the last few years this wonderful correlation between sales of skinny denim jeans, breakages of mobile phone screens, smartphone screens, and the volatility of balances in current accounts. Now to them that's just a correlation, a very interesting correlation between three sales, right? Sales of jeans, breakages of mobile phones, and volatility of current account balances. Now instantly the economist in me, and I'm sure the economist in many of you, starts thinking, well hang on, there's a third factor at work here. The demographic of 18 to 25-year-olds, that is more likely to buy skinny jeans, might also be more likely to go on a night out where they break their phone and also spend a lot of money the day after they're paid, and so have more volatile balances. The big tech firm weren't thinking about that. They identified that one really interesting correlation that they could use not only to sell replacement smartphone covers, but also use to manage the risk around current account balances. There's a question though of how robust that is. I think that correlation was based on a couple of years' data where skinny jean sales had rocketed. There's a question about what happens going forwards. Now, if that's just a correlation on which people are making decisions around advertising, that might not matter. But there is a lesson there that some of these big data machine learning techniques might not necessarily be great at spotting the next crisis, particularly if that crisis arises from endogenous risk within the financial system, or changes to the structure of the system or market participants' behaviour. I suppose we saw one example of that earlier this year in equity markets. In February, there was this growing vulnerability around the selling of volatility and the low level of equity volatility. Market participants were very aware of that, but because they were aware of that risk, their attempts to protect themselves and de-risk themselves from being too exposed to that problem ended up themselves amplifying volatility. And in those situations where the structure of the system is changing, there's a question around how good some of these statistical techniques would be in forecasting risk. Coming back to Regtech and Suptech, there's also an interesting question of whether or not we might end up with a situation where potentially some market participants might start gaming the new reporting standards. So if we end up with machine-readable rules, and if we end up with machine-readable rules that market participants understand how regulators act upon, might we end up with a situation where people start structuring their data and behaviours in a way that makes their risk appear lower than it actually is? It's just a thought.
Thank you very much. I think it's nice. It concludes also the objective we've been discussing on this panel and opens the floor to the questions. Gentlemen. If you could introduce yourself and explain who you're addressing the question to. I think it's coming. The second mic, please. Can we have the second mic?
Thank you. Okay, now it's working. Thank you. This is Timur from Central Bank of Turkey. I have actually two questions, and I guess that they will go to Günther. The first one is about the data quality. On one hand, we know that it's not more only statistics, which was like 2 decades ago. We would only consider analysis on aggregates, but now we are much more dependent on granular data. Just $1 billion the difference in data quality is much more important than it was way before. This is the data quality is very important today, and it will be in the future. This is on one hand, but on the other hand, we have all those technology of machine learning and artificial intelligence, where we may be we do not depend too much on 100% accurate data. We might cope with less accurate data, but still can better off on analysis. And so this, I want to ask your opinion on that. This is on the first question. And the second one, so we are now thinking about getting data from financial sector, which I think the dream of not reporting and no reporting at all is something, and we should go there. But we have way to go, and we have some skepticism that I can understand. But combining data with other data from real sector maybe, or other institutions of public sector. So to give some examples, like trade data, international trade, and like social security data, where employment data, for example. And if you go on the household side, mostly maybe on the education of those people and that kind of data. So combining all of these in one big data lake, so to speak, would bring much more value-added analysis and policy tools. So since we have all those skepticisms and harder to get data in a pool mechanism, harmonization, and all those problems you mentioned, I felt like it's much more harder to get that big data lake of all those public institutions data gathering together. Can you please elaborate on that?
100% data quality, I guess this should be, or is not the aim. It's also very complicated to analyze and to find out if you have already 100% data quality. But if you want to use granular data in the sense of reducing redundancy, if you want to use this granular data also to produce aggregates on the central bank side, then this granular data must have at least a basic quality. And if you want to use this granular data with different tools to explore risk, to use it for stress testing, then you have to rely on this data. So I completely agree with you. It cannot be the aim to have a 100% quality of granular data. In contrast, we should reduce the efforts for data quality management. For instance, with some new techniques, like machine learning, deep learning algorithms, but they have to be proved if they really can explore or can really find mistakes. Of course, these new techniques should be applied for data quality management. So data quality management should be at the end, should be much more efficient. But what I want to say is that the aim should be that the data quality management should be done at the basics, at the granular level from banks. And if there is a good quality at the micro level, then it is more or less, then it is guaranteed that the aggregates quality. At the moment, at least in the euro area, the banks check their data on a granular level. Then the data are checked in another step from different units in the bank. And in a third step, the data are checked by the central banks or by the competent authorities. And in the last step, the data are checked by EBA or ECB in the last step. So in principle, we have a very burdensome quality management process. And from my point of view, this could be reduced if we could more concentrate on the data quality of the basic data, of the granular data. But that does not mean that we go for a 100%. So we have some thresholds and we have a top-down approach. But don't think, at least this is my experience, that the aggregates have a 100% quality. What is 100% quality? And the second thing is, of course, this is a difficult question. Of course, you're right. This is also my experience. The financial sector, and for instance, with banks, you can go for such a project, like in Austria. But for the public or non-financial sector, it's much more difficult. This is for me a completely other topic. Some information you can get to combine data about non-financial institutions, about households, you can also get from banks. Because if you want to have a loan, you have to fill in as a private household a lot of data, and these data are stored in the bank. So at the end, you still go to banks to ask also for data from non-financial sector or from private households. Then it's more easier, it's still burdensome for banks, but it's always easier to go to the financial sector, to investment funds or to banks to collect data than to collect data directly from non-financial institutions. But of course this is quite interesting to combine all this data.
Do we have any more questions? Okay, well, I think that we're just finishing in time for lunch, and I'd like to encourage all the participants to prove that we're all social animals, and despite the age of technology and digitalization, and carry on the dialogue over lunch. With this, I'd like to ask you to join our hands together.